Understanding the fluctuations of the stock market is essential to creating asymmetric risk and reward opportunities. In this video, we will explore the meaning behind the terms bull and bear markets and how you can use these to your investing advantage. There are three directions that market prices can go: up, down, or sideways. When market prices are going up, investors call it a bull market. The term bull market is generally used when market prices have risen by 20% or more from their recent low and are expected to continue going up. The term bull market gets its name from the way a bull attacks. Bulls thrust their horns in an upward motion. Bull markets usually start after the end of a market period where prices are falling. While the length of a bull market can vary widely and greatly, some bull markets have lasted for several decades. When market prices are going down by a lot, investors call it a bear market. A bear market is when market prices have fallen by 20% or more from their recent high. Bear markets can occur for any length of time. There have been bear markets that are complete in a few weeks, and there are bear markets that have lasted for decades. The term bear market refers to the way a bear attacks its prey by swiping its paws in a downward motion. Another term that is commonly used to describe falling market prices is a correction. When a market falls by at least 10% from its peak, it's called a correction. This is in contrast, as stated before, to a bear market, where the market falls 20% from its peak. When assessing the United States stock market, on average, corrections have occurred about once a year since 1900. It is important to note that on average, less than 20% of all corrections turn into bear markets. Putting it differently, that means that 80% of corrections do not turn into bear markets. Peter Lynch, who returned 29% a year as the famed fund manager at Fidelity Investments, says, "The key to making money in equities is not to get scared out of them." If you listen to the news, you will hear dramatic and fearful information about the market. The news loves talking about volatility and things that cause market mayhem. They will talk about conflicts affecting global oil prices, the United States debt ceiling standoff, Brexit, or an economic slowdown in China. Instead of getting distracted by all the noise, it helps to focus on a few key facts, such as there has been on average a market correction every year since 1900, as stated before. Also, the average length of a market correction is 54 days, so that's just less than 2 months. Still, when you are in the middle of a correction, you need to instill your Spock brain and act rationally. We talk about the Spock and McCoy brains in the video Behavioural Investing with Mr. Spock. Bear markets and corrections can be tough because your brain will want to avoid the pain of losing money. Nobel Prize winning psychologist Daniel Kahneman outlines this in his book Thinking Fast and Slow. He states that financial losses cause people twice as much pain as the pleasure they receive from financial gains. The term used to describe this mental phenomenon is loss aversion. The trouble is that losing money causes investors so much pain that they tend to act irrationally just to avoid this possibility. For example, when the market is plunging, many people sell their battered stocks and go into cash at exactly the wrong moment instead of snapping up bargains at once-in-a-lifetime prices. Hedge fund manager Mark Yusko says, "Investing is the only business I know that when things go on sale, people run out of the store." When market prices are fairly stable, investors call that a sideways market. A sideways market is when market prices trade within a fairly stable range for a long period of time. Bull markets, bear markets, corrections and sideways markets are most commonly associated with the stock market, but they also occur in other types of markets. There have been bull markets, bear markets, corrections and sideways markets in bonds, interest rates, oil, precious metal, cryptocurrencies, real estate and other types of assets. Corrections and bear markets can be among the investor's greatest gifts. Think of the recent COVID crash in 2020. In March 2020, Apple traded at $57 a share. Now it's trading at over $170 a share. The same with Microsoft, which was trading at $137 a share in March 2020 and is currently trading at over $300 a share. The Australian global financial services company Macquarie Group is another example, with shares trading at about 80 Australian dollars in March 2020, and today they are trading at about 170 Australian dollars a share. That is why investors like Warren Buffett and Charlie Munger get excited during bear markets. The turmoil enables them to invest in beaten up stocks at such low prices that the downside is limited, but the upside is spectacular. Warren Buffett has a quote which reflects this, which is, "Be fearful when others are greedy, and be greedy when others are fearful." This quote by Marcus Aurelius can assist us when dealing with corrections or bear markets. If you are distressed by anything external, the pain is not due to the thing itself, but to your estimate of it. And this you have the power to revoke at any moment. You can learn more about how the meditations from Marcus Aurelius can make you a better investor in the video Stoic Philosophy to Improve Investing Mindset with Marcus Aurelius. There you have it, understanding bull and bear markets, so that we can all become better investors.